Guys, there's 3 stocks that are selling near their 52-week low. Stock number 1, Monster Beverage, one of the best performing stocks of all time. 60,000% return. Guys, in 1990, the stock was essentially at 2 cents per share. In 2006, it had hit $2.72, which is equivalent to a 130 bagger already. And since then, it's up almost 20 times. That's the point, guys. These companies that compound on each other and compound on themselves. This is what is amazing about the power of compounding. This is what's absolutely incredible. Now, Monster, I'm absolutely floored that they were never bought out by anybody. And I don't personally drink Monster beverages. I'm addicted to Coke Zero. But one thing I love about this company, market cap $51.5 billion. Look at this enterprise value, 49.3. They have more cash on hand than debt. They generated $1.4 billion last year in free cash flow, 1.16 in the last 5 years, and a great 5-year return on invested capital of 16.2%. Now let's go check out their financials. I want to show you guys this revenue growth number. Now, revenue, 10 years ago, 2.5 billion, 2.7, 3, 3.5, 3.8, 4.2, 4.6, 5.5, 6.3, 7.1. Just consistent growth and really high growth at that. This is pretty impressive stuff, guys. In the last 12 months, 7.34 billion. Now, here's the interesting part about Monster. Most of the ones that have a 100-bagger and huge gains, they bought back a lot of shares. Not this company. 10 years ago, they had 1 billion shares outstanding. Now they have 1.4 billion. They've actually gone up 40 million shares in the last 10 years. Let's go back to 2000. Where were they in 2000? Let's check it out. In 2000, they had 960 million shares outstanding. So they're still up from 2000. So this is a company that was able to compound without buying shares back. Isn't that incredible? Why? Well, it's because of their revenue. Because back in 2000, they did $71 million in revenue. Their revenue is up 100x in the last 23 years. Big time growth. Their revenue is up 100 times in the last 23 years. So this sounds exciting, right? Well, let's make sure. Let's go to the 8 pillars here. 8 pillars that we know and love. 6 check marks. Everything's great except for the valuation metrics. One thing I don't like is their 5-year free cash flow is lower than their 5-year net income. And, almost 20% lower. Kind of, okay, what's going on here? That's something you need to understand before you buy this company. But like we said, go back to this chart, the 1-year chart. It's down 16.5%. I mean, it's very close. It got very close to October 2023 lows of $47.13. So again, it's exciting to look at 52-week lows. It's a great place to start to look for value, but you still got to then do the analysis, the quick analysis, sit there and say, is this company still a good value? Let's see what the analysts are saying. 9.9, 10.1, 9.9, 10.1, 7.2% growth every year in revenue going for the next 4 or 5 years. Earnings per share, 14.5, 14.29, 11.5, 15.5, 10. So some really good even growth in EPS and revenue for this company. So this company still has more fundamental growth involved. The question is 44 times free cash flow, is 38 times earnings a little too pricey? Well, let's go look it up in our stock analyzer tool. I don't think I've ever done Monster. Let's look it up and see if I have. Monster, I did do Monster back in June of 2022. Now, I'm going to make some adjustments here to my growth assumptions. So here are my 10-year growth assumptions. 5, 7.5, and 10. So free profit margin and free cash flow margin, as you can tell over the last 10 years, free cash flow has been lower than profit. I think that's a really important thing to understand before you invest in this company. Why has it been lower? Because over long periods of time, they should equate out. PE, I put 15, 18, and 21, which is higher than before because I do think it's a high-quality company with a great balance sheet. And remember, that balance sheet has about $2 billion in extra cash there. And I did my 9% market return because the market does 9 or 10%. So I'm trying to find what I consider to be the value. But remember, you need to put margin of safety. Because if you're not going to, then just buy a low-cost ETF. There's no reason to buy any individual company if you want to make the market return, in my opinion. So let's hit the Analyze button. Congratulations, I got points for using the software. I have a low price of 26, high price of 55, middle price of 38. So for me, margin of safety might be $30. That's just hypothetical. I'm not saying that's the right number. I'm just telling you, it seems a little pricey to me right now. Stock number 2, Pepsi. Current price, $166. You all know, who are normal to the channel, that I love Coke Zero. But I will say this, Pepsi Zero is a phenomenal drink. Diet Coke, in my opinion, is better than Diet Pepsi. But I do love Pepsi Zero Sugar. I think it's a great drink. I love it when I go to Taco Bell and stuff soft tacos and chili cheese burritos in my face. I love washing it down with a Pepsi Max that you get at Taco Bell. Now, this company isn't as close as it used to be to its 52-week low, but it's there. It's close enough. I mean, the company has been public since 1987, and the total return just in dollar value is 2,600%. Remember, what was Monster? 57,000 or 60,000%? Night and day difference, right? Both beverage companies. Different balance sheet. $230 billion market cap versus a $3 billion enterprise value. So about $73 billion in debt, net debt. Now, one thing I don't like about Pepsi, dividend of 3%. I know all the dividend lovers out there, it's the best thing ever. We love dividends. I get that. But this dividend ate up $6.8 billion of their cash flow. Last year, they did $7.2 billion in free cash flow. Guys, that's like 95% of their free cash flow. That's a lot. I look at that going, is that sustainable? I don't know. Their profit margin, very consistent, 10% essentially. Same gross margin as Monster. Good returns on invested capital, 15 and 16%. I think we'd all agree that even though Pepsi is not the number one soft drink company in the world, they're a great brand still. They're very well known, and they have great commitment from the people who do love them. I used to be a Pepsi guy. Then I met Coke Zero, and I was like, all right, Coke Zero. These income statements, I mean, the revenue growth isn't as exciting. 66, 63, 63, 63 and a half, 64 and a half. And last year they did 91.5. So, I mean, it's growth, but not a ton of growth. Let's go see what the 8 pillars look like. Very similar to Monster, except for this debt. Now, you couple the debt with the high dividend yield. Do I think Pepsi is going out of business anytime soon? No. With that said, what's the first thing they would cut if things started to get a little tight? That dividend. I'm not saying the dividend for sure is going away. Probably isn't. However, it's a high dividend that eats up a lot of their free cash flow. So don't buy any company based on dividend. Because remember, it's tax inefficient. And I personally believe it's the last thing that any company should do with their cash is pay out the dividend. There's so many other things they can do. If you can buy back cheap shares, but the question is it cheap? Well, it's selling for 31.5 times free cash flow, 25 times earnings. So another company with less free cash flow than earnings. And it looks like the difference is actually a lot bigger with Pepsi. So these are the things to discuss. These are the things to understand. Remember, investing, it's about the numbers, but more importantly about the emotion of it. You need to be able to make a decision based on fundamentals and then hold on to the company for long periods of time. Go back to Monster. They were at 2 cents a share. And of course, you sit there and go, yeah, Paul, 60,000% return. Yeah, but from 2000 to 2002, the stock went down a ton. You have to be able to say, yeah, but the fundamentals are getting better. That's the hard part. That's what makes investing difficult because we're all programmed to look at the stock price going up and down. But I'm trying to teach a little bit different here. I'm trying to get you to understand the fundamentals. And then if the price goes lower, but the fundamentals are still okay or the same or better, you continue to buy. Because the fundamentals on Monster were getting better even if the stock fell. You've got to be able to do that. Because most people out there, all the lemmings out there, just look at stock price and that's it. I want you to be different. So if you'd like to be different, click the link in the description below for our software, more importantly, our community with thousands of like-minded investors that you can have these exact conversations with and help you during your process to make your returns better and make your life much easier to live. So click that link in the description below. Now, let's see what the analysts are saying about good old Pepsi. All right, 8% EPS growth. All right, 8.5, 8.25 to 1087. Revenue growth, I'm going to guess low, mid-single digits. Yeah, 2 to 5%. Okay, that's about what I expect for Pepsi. I mean, how are they really going to, I mean, it's Pepsi. It's like Coke. I mean, they're not going to grow at 20% a year. It's just not possible. I mean, as the world gets, I mean, I think I remember Warren Buffett saying the average person in China, this was years ago, has 1 Coke per year, but the average person in the US has 1 Coke per day. So those are the growth potential in India, and in China and other emerging economies. All right, so let's see the stock analyzer tool and see what's going on with Pepsi. All right, let's see some of the assumptions I made on Pepsi. 10-year analysis, I did 2%, 4%, and 6% revenue growth. Guys, I'm not going to lie. How the hell are they going to do 6% revenue? That'd be hard. Profit margin, basically it's 10%, so I put 9.75, 10 and a quarter, 10.75. But look, free cash flow, I went lower, 7.5, 8, 8.5. PE, I did 17, 20, and 23. Is my bias towards Coke showing up in that? Should I put a higher number? That's the reason why if you use the software, you're probably going to do a little better, but you're going to make your decisions based on what you feel about the company. And again, my 9% no margin of safety return. The analyze button, got a low price of 75 to 100, high price of 140 to 180, middle price of 100 to 135. So even if it might hit a 52-week low, I think it's a little premature. Company number 3, Intel. Has this company been on a wild ride or what? It's at $30.64. Guys, I have Intel, but again, don't ever buy a company because somebody on the internet has it. We're here to teach a process. I will gladly share with you my views on Intel, but you need to make your own decisions. For me, Intel is purely a turnaround play. That's it. To me, the fundamentals are a little hodgepodge right now. Revenue's down, rebuilding. Do I think they're going to benefit from AI? Absolutely. Do I think they're benefiting as much as they should right now? No. They're building or have built 3 amazing factories in 3 locations, one of which an hour and a half down the street from us in Columbus. I think Intel has been beaten up rather thoroughly. The 52-week high was $51 back in December. 52-week low was just a month ago at $29.73. So we're right there on the cusp of it. But again, this is a multi-year turnaround play. This stock has been as low as 22 to 23 in the last couple of years. Let me see. Yeah, 24.59. That was the low. That's pretty low, guys. Pretty low. This is a stock this is what I love showing about the stock. This was one of the poster children of the dot-com age. It has not hit its all-time high of $75 back in August of 2000. It's been that long since all-time high. Look at it. And guess what? The business has gotten better. This is a great learning lesson. This company, Cisco, there's so many companies like that where even the ones that are still around like Microsoft and Amazon, they're not up as much as the revenue and profit is up from their peaks. So it just goes to show that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, do I think Intel's beaten up a little bit? I do. But actually, the funny part is I think my fair price on Intel, even if they succeed, is only a little bit higher than what their all-time high was. So it just goes to show that it's very difficult when you follow the hype. And it's very difficult that even if you pay for a great story, the story shifts over time. That story shifts and the price falls. The question is, which story was correct? Usually when it's going up and up and up, that story is not correct. And when it's crashing, that story is not correct. There's somewhere in the middle that over time it gravitates towards. So let's go look at the analyst estimates for Intel. Now, they're expecting $1 per share in profit this year, up to $5. Now, remember, guys, don't take analysts as like, oh, they're brilliant. They have the same bias that you and I have. We all have the same bias. I love the fact that everybody's so negative on Intel, yet the analysts are showing growth. And if they're able to hit $5 a share, multiply that by 15 to 17 times, you're looking at $75 to $85 per share in value. Okay, that's not bad. If they hit this, like I said, it's a turnaround play. Their revenue fell tremendously lately, but analysts have them growing considerably up to $93 billion in revenue in the year 2028. So if they do this turnaround well, this could be a great multi-bagger, but it's not for the faint of heart because this thing is ugly before it gets better. Now, I got lucky on Intel. I started buying at 45 all the way down to 25, and I sold it at 48 on its massive run up. And then I started buying again at 35 as it fell. So I've done really good on this company. Borderline trading, but I remember at 48 bucks going, I don't think the juice is worth the squeeze here. So I exited and then it started to go to 51. I'm like, oh crap. I think it even got a little bit higher than that. So I was like, okay, maybe I was wrong. That's fine. But I was okay not owning Intel at 55 or 60 bucks a share. That was fine for me. But then it started to fall again. I'm like, okay, now we're getting back into it. So again, this is a turnaround play. These are the conversations to have in our community. These are the reasons why you need our tools. Guys, I'm not going to do a stock analyzer on this because it's a turnaround play, but do me a favor, watch our last 52-week low video. It's a great place to look for value. Thank you for your time.